Hey, everybody, it's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday. Each week, I'm going to break down the complexity of what's happening in real estate, mortgage rates, and the economy into something that almost everybody can understand just the way you consume it best. So, if you really don't care how the clock's built and you just want to know what time it is, the first minute or so of this video, it is for you. Now, I'm going to give you the highlights quickly so that you can go about your day. I don't want to bog you down and hurt your head with a bunch of information you just don't care about. But if you like a little bit of context and you enjoy learning how things work, but not so much that you're quitting your day job to become an analyst or a clock builder, stick around. And then at the end, for my friends that really like to understand what's happening, we're going to do a clock builder segment and connect all the dots. So let's go ahead and get started. Markets are actually starting the week on a positive note. Both stocks and mortgage bonds, they're both higher, and that's generally pretty supportive for mortgage rates. Now, over the weekend, the U.S. captured Venezuelan leader Nicolas Maduro on drug and weapons charges, and it's still kind of a fluid situation, and oil prices really haven't done anything yet, but this is something that we're keeping an eye on because global energy and geopolitical risks, they make a huge difference in inflation expectations. So, we also heard from two voting Fed presidents this morning, and both acknowledged that the labor market is clearly weakened. Philly Fed President Anna Paulson said that the labor markets look soft, but she expects it to stabilize a little bit later on this year. She actually believes that inflation is going to continue to moderate and that rate cuts they could come later, just not yet. Now, Minneapolis Fed President Neil Kashari echoed that labor has cooled and said that wages are decelerating, housing inflation is easing, and non housing services inflation should continue to slow as well. However, he believes the Fed's currently at neutral and doesn't think cuts are necessary right now, though he did emphasize that they're well positioned to cut again if inflation falls and labor weakness actually continues. He also kind of warned that inflation could spike temporarily in January as prices usually reset for the year, especially in areas like healthcare. Now, from a technical standpoint, mortgage bonds have found support at their 25 and 50-day moving averages, and they're moving higher. The 10-year Treasury, on the other hand, it again failed to break above that 4.2 level, and it's now testing lower levels. So here's where mortgage rates sit this morning. According to Mortgage News Daily, the 30-year conventional fixed rate is around 6.2, the 15-year fixed is around 5.75. FHA, their 30-year is around 5.83, and VA 30-year is around 5.9. Now, these are national averages, everybody. Your rate may be higher or lower depending on your credit score, your equity, the loan program, and of course, timing, but this should give you a pretty solid snapshot of where things actually sit today. The bottom line for now is we're going to begin the week floating, but make sure you have a plan. If you're conventional and you're considering a refinance and you've got a 6.625% rate or higher, it might be time to at least start the conversation, as long as you're not paying any discount points. Now, for government loans like VA, FHA, USDA, it might be worth a call if you're around 6.375 or higher. Now, that's it for everybody who just wants to know what time it is. If you're finding this information helpful, please like and subscribe. If not, that's okay too. Please just share it with somebody who might need the help. I really do appreciate it. Now, for my friends that like to know how the clock works, let's add a little bit of context here. What's interesting here is the disconnect between headlines and positioning. On the surface, the Fed sounds patient, not ready to cut yet, and that makes pretty good sense. Inflation's not gone and the economy hasn't broken. But under the hood, we've got a couple Fed speakers acknowledging the same thing. The labor market has cooled, wage growth is slowing, and housing inflation continues to decelerate. That's important because those are the ingredients the bond market really cares about most. And if you're new here, remember this. The Federal Reserve does not set mortgage rates, the bond market does. When mortgage bond prices go up, mortgage rates come down. Now, here's where people get a little bit tripped up. When they hear the Fed say, we're not ready to cut rates yet, they assume that that means mortgage rates have to go higher. But mortgage rates don't wait for the Fed action, they actually move ahead of it. The Fed controls short term rates, mortgage rates are long term rates. So while the Fed's focused on what inflation looks like right now, the bond market's actually focused on growth and inflation in 6 to 12 months. And right now, the bond market sees an economy that's still growing, but clearly slowing. That's why you can hear cautious Fed language at the same time mortgage bonds are improving. And it's not a contradiction, it's just timing. Add to that the fact that inflation data often runs hot in January due to annual price resets, and you get exactly what we're seeing now: careful Fed messaging, but improving bond market behavior underneath. Now, this week's data should definitely matter. Wednesday brings ADP and JOLTS, Thursday is jobless claims, and Friday is housing starts and the official BLS jobs report. Now, no single report changes everything, but together they tell us whether this labor softening continues or starts to actually turn. Now, let's slow this thing down a little bit and let's move into the clock builder segment because this fits directly with what we've been talking about over the last few weeks. Here's the key theme we've been building: mortgage rates don't move based on today's headlines, they move based on tomorrow's expectations. Now, the Fed may say they're not ready to cut yet, but the bond market's already looking ahead. Why? Well, because bonds care less about where inflation was and a whole lot more about where inflation and growth are going. And right now, the signals under the surface, they still point to cooling. Labor is weaker than it was 6 months ago. Wage growth is decelerating. Housing inflation continues to roll over, and consumers are becoming a lot more selective. That's why mortgage bonds continue to trend higher, even when Fed speakers sound cautious. Now, let's go ahead and talk about the technical side because this is really where the rubber meets the road. Mortgage bonds have found support at the 25 and 50-day moving averages and now have roughly 18 basis points of room to the upside before they hit resistance at around 99.88. And that's a level that we've talked about before. If bonds can break above that level and stay there, the next move is higher bond prices, and higher bond prices mean lower mortgage rates. Now, at this time, the 10-year Treasury, it's once again failed at that 4.2 ceiling, and it's now testing an interim level near 4.17. Below that sits a triple floor formed by the 25-day moving average, the 100-day moving average, and the 4.126 Fibonacci level. Now, that's kind of technical compression, and usually that happens before a much larger move. Now, here's the bigger lesson: markets don't wait for recessions, they actually wait for deceleration. You don't need the economy to completely fall apart for mortgage rates to improve. You just need growth to slow a little bit. Hiring needs to cool, and inflation pressure needs to ease. Think of it like tapping the brakes instead of slamming them on. Now, this is also why mortgage rates, they move in cycles, not straight lines. That's why you hear me call it a Christmas EKG. It's up and down and up and down. We improve, we pull back, we consolidate, and then we move again. And what we're seeing now looks a lot like consolidation near key levels. And historically, that's often what comes before the next leg. So, what's the strategy for right now? Well, as we start the week, the technical picture supports floating. As long as you're paying attention and you've got a plan. Volatility has not disappeared, and inflation noise may show up again in January, but the trend continues to favor improving rate conditions, not worsening ones. This is also why working with a certified mortgage advisor, or at least somebody who understands how the clock's built, really matters. Headlines don't move mortgage rates, expectations and bonds do. Now, if you're buying, refinancing, or just trying to understand what these shifts mean for your next move, that's exactly what we love helping people with every single day. And hey, don't forget, if there's a local nonprofit charity that's near and dear to your heart, like the Humane Society, the Cancer Research, or maybe even one of the many military or first responder charities that we have here locally, the Shoemaker Loan Team makes a $250 donation each time we help one of your referrals buy a home. So reach out to see how we might help local families achieve homeownership while supporting local charities. Let's make a huge difference together in 2026. Hey, this is Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and I'll see you next week.